Wage growth eased at the end of 2022 to levels that are still historically strong. But both private workers and, let me just show you this chart. Sorry about that. Both private workers and total workers saw compensation rise 1% in Q4 seasonally adjusted and 5.1% on the year. So this is, as you know, very important to the Fed. They're going to be talking about this tomorrow. Supply chain issues have lessened. The inventory glut is also quickly reverting. So that's healthier for retailers, but they still have issues around higher costs from very sticky inflation, and then specifically higher wage demands that have resulted in rising compensation, which is putting pressure eventually, not yet, on compression of earnings. Corporate earnings, I want to go over that real quick, have so far, just kind of an update, have been received well, but it's a mixed bag, right? So Caterpillar, for example, is down a little bit because they missed, but they gave very strong guidance. So they say 2023 will be better than 2022. Hard to imagine, stocks at all-time highs, but that's what they are promoting this morning, which is also helping the sentiment of the market. But let's kind of go over earnings so far to date, okay? Since wage inflation is still a big component of what the Fed cares about, and it is still very seasonally adjusted, even seasonally adjusted is still very sticky. And then we have CPI, also very sticky. Sticky services inflation. This is another article that I was reading this morning. We already know that goods inflation is trending lower, right? But the Fed is closely watching services inflation. And this is a Substack, but I like it because what they do is they take the earnings and they kind of hit the highlights in the calls, right? In the conference calls. And basically, in a nutshell, consumer appears to remain resilient and credit card companies don't see recessionary signals in spending data. Companies are cautious, though, and manufacturers are dealing with inventory destocking across a variety of industries. They've definitely had big manufacturing hits. Anyway, this is going to be the split track in inflation, goods versus sticky consumer. So this is the other part of it, which is data track. Can't show you the article because it's in an email only. Okay, so basically update on Q4 corporate earnings season, right? I'm going to show you this picture while I'm doing it. So this is my chart, which helps very, very, very much for trend trading. And as you can see, we've already had peak valuations in 2021, and then we've had peak earnings also rolled over in 2022. And here we are at the beginning of 2023, and we're underneath this green line and rolling over. So how are we doing? So this is GAAP SPX, by the way. My baseline bet is that we retest this red line, right? This is the COVID craze of QE and free money. So you get the lots and lots of oversold plays that basically got massively bid up. So let's with pent up demand as well. So you got all this drama that I still see as needing to kind of come down and retest, but it can take, remember, this is monthly, so this can take many quarters. But for right now, we've got facts set out basically saying 29% of the S&P have reported. By the way, 20% report this week. So it's a huge week for earnings. And obviously we're only, Tuesday morning. But 69% of companies have beaten Wall Street analyst earning estimates, but that is below the 1, 5, and 10-year average beats. So just keep in mind, they always lower the bar to step over it. S&P companies have reported earnings that are on average 1.5% above expectations, but that is still well below the 1, 5, and 10-year averages. 60% of companies have beaten Wall Street analyst revenue estimates, but these are also still below the 1, 5, and 10-year averages. So on average, corporate revenues are coming in 1% better than analysts' expectations, because you know that they also lowered earnings expectations very, very, very quickly toward the end of Q4. And like all the other financial reporting data, though, this, as I've already kind of emphasized, it's still lower than the 1, 5, and 10-year averages. So even though they're disappointing on both across the board so far, 29%, Q4 U.S. corporate earnings season continues to be disappointing on both the top sales and bottom earnings line. So even though we're up, 6% year to date in this very large short covering rally, right, since the October lows, we have definitely they have had time to analyze, to set expectations lower. And basically, Wall Street estimates had already peaked in April of 2022, literally. So at $61.12 a share, and are coming in at $53.31 a share. That's a 13% difference. So we're only down 12% since the start of April 2022, right? We'd already dropped very strongly from January to April. If you recall, we had a strong bounce in May, and then July to August, et cetera, et cetera. So we've been basically chopping sideways since that April, May hit around 3,800. So since the markets are basically forward looking, and they did a good job of figuring out that the earnings expectations would be falling, they priced it lower, and that's exactly where we are. It's basically within, 1%. So this is basically already priced in, long story short. So we basically have, forward looking. That's why this report for the companies that will give guidance is very, very helpful. And Caterpillar, for example, said it's going to be better than last year. So let's see if we can get some clarity, obviously, in the tech world, because Apple is this week, and that's going to matter. But so far, in a nutshell, this is lackluster. It's just basically, we knew we were going to have strong growth in Q4. We did, right? The 2.9 GDP print. We knew earnings were going to start to come down. They were already priced to come down, and they have. So pretty much it's as preordained, for lack of a better word. So we've got, let's see, what's coming up for 2023. They haven't priced it very much lower, honestly. Okay, so here's what I want to show you. Here we go. All right, so here's the fact set chart I'm kind of reading from, right? Shows you that these recent cuts now point to an earnings recession. Negative year-over-year comparisons for the S&P through most of this year. Okay, that's I guess the takeaway from this review that I'm doing right now, because earnings are front and center this week, 20% reporting, but so far 29% have reported. That's the data that I'm reading. Even though they've lowered it and they expected that back in April of 2022, we basically have not come out of it. We are still facing earnings recession this year. And that means, based on the street's latest estimates, year-over-year earnings per share will be lower than the prior year's comparable quarter in Q4 2022. So they're expecting that we will have negative 3.7. Where does it show that? Does it? Right here, this little feature, Q4 2022. Okay. So a negative 3.7%, negative 2.2%, 1.8% for the upcoming 3 quarters. These are, again, estimates, and these are the actuals. Makes sense? So as the estimates continue to be revised lower, and this is strongly assumed that these estimates will be revised lower, that means that the expected negative comps will then start to increase. So right now, the earnings recession, they're very much the bullishness around the last 2 quarters assumes Fed is going to pivot, cut by the end of the year. Market's going to continue to like the idea of a soft landing and basically grow. That's it. So it seemed a little unrealistic. Okay, but I'm the messenger. I'm not commenting except to say this is what I see. I see a rollover in earnings. It could take a few quarters. They're seeing an earnings recession for the next 3 quarters, and then basically 9%, 10% year over year growth coming in by the end of Q4, unless we hit a recession. In other words, easier comps to beat. Yeah, so we need some modest economic growth between now and then, and no recession. That's the caveat. Does that make sense? So investors are confident the Fed is going to be done raising rates. Tomorrow will have a big impact on these expectations, right? If they get lowered because the Fed gets more hawkish. Right now, it's a 25 basis point step down. They could still raise 50 basis points. That's not priced in. Recession, not priced in. All I'm trying to show you is this happens to be on my mind. So this chart, right? And then, of course, what are the earnings estimates coming in according to fact set? So positive earnings comparison late this year, early next year will require modest economic growth and absolutely no recession. Anyway, but consensus is 18 times. So $226 a share for S&P valuations. And 18 times is high. Remember, the 10-year treasury yield is earning right now 3.5%. And the 10-year average PE for the S&P is 7.2%. So they're really still priced for perfection. They're priced for a Fed pivot. They're not priced for higher interest rates. They're not priced for higher inflation. They really have no expectation right now. And the federal funds rate is futures. What is it? 4.33. Okay. So anyway, the point of this is to kind of, even though I think this growth momentum rally is going to peter out and weaken. That was my baseline bet coming in Monday morning pre-market. And I showed you that chart of how we're coming right into resistance. It really comes down to the market still sees a high degree of confidence that the earnings recession that you can see right here in the next 3 quarters will be shallow and short-lived. And that the S&P will actually earn $250 a share in 2024. So you go into 2024 and they're expecting growth, so that the current right now 2023 consensus of 18 times is $226 a share, roughly. They're expecting a consensus of $250 a share. So 10, almost 11% higher. That's how the market right now is pricing in higher stocks. And if they are too optimistic, then obviously we will see a lot of repricing. Yes, I saw the Samsung results. That was scary. It really was very, very, very negative. So far, market doesn't care. Market does not care. Forward, and just so you know, I'm putting this out here because it's context. You will see so many charts that show forward EPS growth about to go red, et cetera, et cetera. But that's short term. They're still pricing in $250 a share S&P valuations in 2024. Yeah, and of this, the takeaway for the most part is just remember that earnings analysts are expecting a 10% growth next year, 10, 11%. U.S. large caps look overpriced if 2023 earnings do not hold up in line with analyst expectations. And my baseline bet is they will not.